Hello and welcome to S&P Global Ratings Fixed Income in 15, a 15-minute chat with a market voice and an S&P ratings analyst. My name is Joe Cass. I head up market outreach in the UK. Today I am very fortunate to be joined by Gerard O'Reilly, Co-Chief Executive Officer and Chief Investment Officer at Dimensional Fund Advisors, and our Global Head of Research, Alexandra Dimitrijevic. Thanks very much for joining me, Gerard and Alexandra.
Thanks for having us, Joe.
Thank you.
Before we start, a quick reminder that the views of the external guests on the show today are their views alone and they do not represent the views of S&P Global Ratings. So Gerard, let's kick off with some questions for you. It's been a turbulent environment for some fixed income investors and managers this year. What has your experience been at Dimensional over the past, say, 4 to 5 months?
So thanks for the question, Joe, and I'll answer it in short and then elaborate a little bit. In short, we've had no issues managing the strategies, trading the strategies, meeting client subscription and redemption requests. Now, to understand why there's been no issues, it would probably be a good idea to give a little bit of background on Dimensional, in particular the who, the why, or the what and the how. And the who is, well, what do we do? Well, we've been managing fixed income since 1983, so we have lots of experience over many different market crises. We manage about 110 billion US dollars in fixed income, and that's in US governments, in non-US governments, in corporates, in municipalities, in securitized, in a kind of a broad range. And from AAA down to BB, 0 to 30 years plus, depending on the strategy. So quite a range of investments, and that's the who. The what, systematic. We're a systematic manager, and we have been since 1983, so one of the pioneers in this space. And what that really means in some respects is that it's a rules-based approach. So a lot of the good things that indexes bring to the table, broad diversification, low cost, you know what you're getting, the rules define what the strategy is, and these can be communicated straightforward to investors. But then we add lots of value on top of indexing by considering expected returns, more robust risk management. So lots of value added from our process. So that's the what. Now the how. The how is market prices. We think that market prices contain lots of reliable information. They're basically predictions of the future. And that includes the prices of stocks, bonds, options, swaps. All those types of securities contain lots of information in their market prices about the future. When it comes to bonds, they contain information about differences in expected returns across different maturities, different credit qualities, different currencies of issuance, and also differences in risk across those instruments. To give you some examples, let's talk about credit. What information do we have on credit spreads? There's information about credit premiums. How big are expected credit premiums? So coming into the start of this year, as an example, credit spreads were pretty narrow, and so we would have been underweight our maximum allowable allocations in credit spreads. In March, they got a lot wider. We increased our overweight to lower credit quality bonds, triple Bs, double Bs, and so on. That worked well over the course of the second quarter and up till to date. And so that would be an example of using that information that's changing pretty quickly, but always reflected in market prices about differences in expected returns. So in summary, no issues, but it wasn't for lack of hard work or that we were managing very simple strategies. It's because we design our strategies with kind of crises in mind, and how do we make sure we can continue adding value in times of market distress, as well as normal market environments.
Thanks, Gerard. So what is your broad outlook for the markets, specifically on the credit side of things?
Yeah, thanks for that, Joe. I'll go back to some of the earlier comments I made around market prices containing predictions of the future, and start off maybe with a global view and then narrow into the questions on credit. At the start of the year, if you looked at yield curves around the world, probably on a currency hedge basis to US dollar, euros and sterling were offering some of the higher expected returns. Over the course of the year, yield curves have flattened. So what does that tell you? Well, what that tells you is if you have a short-term strategy, let's say 5 years and less, in a flat yield curve environment, there's not much of a difference in expected returns across bonds of different durations, 5 years and less. And that's broadly true for sterling, for euro, for Canadian, and so on, and as well as US. So effectively, when you think about global diversification, it's important right now. We don't know where interest rates may go in the future, but what we do know is that global diversification helps mitigate any large movements of any one yield curve. So an outlook there would be global diversification is important. If you're in a short-term strategy, go shorter, largely because that's where the higher expected returns are in terms of information from yield curves. What might change that? Well, if yield curves around the world start to steepen up, then that could be a good reason for short-term strategies to go a little longer. On the intermediate side of things, I think there's some steepness in yield curves, so you get some roll down. So there, generally speaking, probably your underweight yen tends to be quite flat, maybe overweight, euros, sterling, a little bit underweight US dollar. So that's kind of a broad view on rates. In terms of credit, well, credit spreads, as we mentioned at the start of the year, were quite narrow. They got very wide in March. They came back down afterwards. Now they're kind of at their historically average level. And when I say historical, I mean over the past 30, 40 years, give or take. So that means that a lot of our strategies have close to their maximum allocation on credit. And the reason for that is just the expected credit premium. Now, questions about the future. Well, there's still a lot of uncertainty in the economy, so it's important to keep an eye on credit premiums. If they come in and get a lot narrower, that might be an indication that you want to reduce your exposure to lower credit quality bonds. If they stay where they are or get wider, it's maybe maintain. Another kind of detail on credit that I think is important is that uncertainty in the economy. When there's a lot of uncertainty in the economy, there's going to be winners and there's going to be losers. And that means that credit monitoring is particularly important, in particular as you go down that credit quality spectrum. We mentioned some of the tools that we use here at Dimensional that looks at market prices from lots of different sources to update credit quality all day long, every day. And I think that's an important aspect of what we're going to see over the next few months. We've had higher default rates this year, higher downgrade rates this year. And I think that has the potential to continue as the economy shakes out. We see where COVID-19 goes. There'll be some winners and losers. Having real-time credit monitoring is an important aspect of managing any credit strategy, in particular if you're going to maintain that kind of allocation to lower credit quality bonds. So that kind of in a nutshell, where we are today based on market prices and what may happen if market prices change in the future.
Great, thanks, Gerard. That's a good segue into a question I was looking to ask you, Alexandra. So at S&P, we're continually asked about default risks by investors. So would you be able to give an overview of the default rate in Europe and the US? Are they better or worse than we initially expected when the crisis began?
Yeah, thank you, Joe. And first of all, fascinating to hear that presentation from Gerard. And I guess I'll bring back the discussion to credit fundamentals from the interesting insight on market pricing, and maybe also compare a little bit the two. Just to see where we are now. So we just published the default statistics for August, and we're getting at 6.2% for speculative grade corporate in the US and getting closer to 4% now in Europe. So this is trending up, obviously, but it's fair to say that it's probably lower at this stage than we would have initially anticipated at the beginning of the crisis. And one big reason for that has been the massive monetary stimulus that took place both with the Fed, the ECB, Bank of England, but also very strong fiscal support. And this massive support has averted first the liquidity crisis and also cushioned a lot of the credit risk in some sectors most exposed to the lockdown. So where we've seen a spike in default has been oil and gas with the collapse in oil prices, but as well retail, consumer goods, media and entertainment as being more exposed to social distancing. Now, from where we are now, there are still lots of uncertainties, and in particular, it will be very interesting to see what are the implications of the withdrawal of this extraordinary support, because governments can't continue to pay wages for companies forever. So at this stage, our base case forecast for the next 12 months is for defaults to increase to 12.5% in the US and 8.5% in Europe. But where that's really interesting, and getting back to what Gerard was saying, is the increasing gap that we're seeing between the market pricing and the credit fundamentals, with market indicators suggesting more default rates actually trending down in the US to rather 4%, as opposed to going up. And I think this is really a reflection of the high amount of uncertainty that remains, particularly around the evolution of the pandemic.
And Alexandra, to get a better picture of where we are right now, what's the scale of our rating downgrade thus far into the crisis? And what rating levels are we seeing, or in which rating levels are we seeing the most movement?
So we're publishing every week the list of rating actions related to COVID and the collapse in oil prices. At this stage, for corporate and governments, we've had around 2,000 rating actions. Half of these are downgrades, and half are credit watch and outlook changes, mostly outlook 850. So that's a bigger picture. That represents, for the corporate segment, for instance, 20% of corporate rating globally have been downgraded. But behind that headline, there are massive differences between the ratings level and the sector. So at the rating level, 80% of all the rating actions have taken place in speculative grade category, and most of the downgrades have taken place at the B level and below, which is really in line with the ratings definition. As the lower you get in the scale, the more vulnerable you are to changes in economic and financial cycles. And by sector, you wouldn't be surprised that obviously sector most exposed to the impact of social distancing. So we've had transportation, auto, oil and gas, media and entertainment, capital goods, retail and consumer product, really leading some of these rating actions. 2 points interesting. One is that we've had a peak of rating action in March and April, but since then the pace of actions has slowed down significantly, as we are now in the exit period from the peak of the crisis. And we have a lot of resolution of the outlook and credit watches. And maybe to finish on a rather, maybe more optimistic note, is that we think that there might be a turning point over the summer, in the sense that the net outlook bias, so that's negative minus positive outlook, remains very high. It's like 50% of US corporate in speculative grade, but we're seeing a turning point, which might indicate that we are on the shape of recovery now.
Great, thanks, Alexandra. So now we're going to move on to some non-market related questions. Gerard, I'll start with you. Dimensional manages around 500 billion US and has a history of recruiting world-famous intellectual minds. Myron Scholes, Eugene Farmer, David Booth is your chairman. And I know you yourself are a qualified rocket scientist with a PhD in aeronautics. So can you talk a little bit about the academic culture at Dimensional? What's it like working around those kind of profiles?
Short answer is fantastic. You get challenged every day and you always have to improve up your game, and that's what I like. Kind of a bit of a broader answer in terms of the overall culture, very similar to academia. In academia, it's all about the pursuit of the truth. I did my PhD at Caltech, where the motto is "the truth shall make you free." And that's very similar here at Dimensional. We look hard for the right answer, and that's the one we try to get. We never try to defend the wrong answer. And that's an important mindset when it comes to solving problems on behalf of clients and investors, making sure that you're always trying to do the right thing and do it in the right way. And that's very much a kind of an academic mindset. So good, healthy debate. Ego's left at the door. Let's get to the right answer and then move on and solve the next problem. Yeah, so Great. That's how we approach things.
Alexandra, we are now in September. I know you have 3 children of different ages who are now finally back to school after many months. So how has the homeschooling experience been for you and your family?
Yes, so indeed, it's been a much awaited time, and all kids are finally back to school now. And I have to say they're probably as happy about it as we are. And I'd like to offer some reflections here that, for me, at least, I think this lockdown period has shed some light on the importance of school, not only for the education on the teaching of our children, but very much for the structure of the society as a whole and the role it plays in socializing the children, but also bringing a framework. And the other point I'd like to share, which I feel very strongly about, is also the key role that schools are going to play in shaping the future for our economy. Because what this pandemic is causing is some job destruction, but also acceleration of move towards a digital world. And I think that the schools have a role here in helping our children prepare for this new type of job in a digital world.
So Alexandra, another one for you. At S&P, we've been working from home since around March time, which is really a significant amount of time when you look back on it. So has the experience thus far changed you or even changed the way you approach work in general?
So the answer is yes, and it's a bit of a paradox. Actually, I have a global role, so my team is based pretty much everywhere from Mexico to Melbourne, New York, and Paris. And I've found that through this period, I've actually gotten closer to my team members because we've spent so much time on Zoom and Sky on Teams and all of these ways of communication. And I've seen an amazing amount of level of engagement from all of them to be able to deliver an answer to the market with timely information. And I found that actually we got close in that period. And I think as a company, what we're seeing now is about reimagining how we work. And I'm sure a lot of companies are doing that, and this will have some durable implications, again, for our societies.
So final question goes to you, Gerard. So we've spoken a lot today about markets, but what kind of hobbies, what kind of interests do you have outside of work or anything that helps you clear your mind, let's say?
Well, like Alexandra, I have a family. I have one daughter, and she is 5 years old. Unlike Alexandra, she's not back at school yet. Here in Texas, they're taking kids slowly, and my daughter probably won't go back into school until Christmas time. So that's been a great source of relaxation and comfort over the summer, I have to say. We've been doing a lot of schooling at home, and on weekends, spend a couple of hours each day doing maths and reading and writing with my daughter has been a lot of fun over the summer. So family time, certainly something that helps me rest, relax, recuperate. Outside of that, then I like to get a bit of exercise in, whether it's running, cycling, a bit of surfing, maybe a bit of time working out, whatever it may be. Also helps takes the mind off all the issues that go on at work on a day-to-day basis. But family, main thing.
Sure. Yeah, I actually have my daughter is 3, so she's they've had sort of going back to nursery has been going for about 2 months, but she's going back in sort of like the big class as of next week. So we're kind of trying to sort of build her up for that slowly, which has been interesting.
Exciting times.
Exactly.
No doubt.
Well, great. Thank you, Gerard. Thank you, Alexandra, for your time today. And I shall see you all watching next time on Fixed Income in 15.